Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Lewis, and we're glad you're joining us today. We've got a fascinating story to kick off our show, as the Bitcoin Treasury trade appears to be entering a new phase. In a significant development, Strive has announced an all-stock deal worth over $1.3 billion to acquire Semler Scientific, another firm with a substantial Bitcoin holding. This merger will create a combined entity with nearly 11,000 Bitcoins, putting it just outside the top 10 among public holders. Now, this move is interesting for several reasons. First, it highlights the growing trend of consolidation in the Bitcoin treasury space. With direct Bitcoin purchases no longer driving the same level of upside, companies are looking to mergers and acquisitions as a way to grow their holdings and outperform the asset itself. This strategy could potentially lead to a wave of similar deals, as weaker firms become acquisition targets for their more robust counterparts. It's also worth noting that this trend was kicked off by Michael Saylor's MicroStrategy back in 2020, which has seen its stock value increase by over 2,300% since then. However, not all companies have been able to replicate this success, with Semler's stock trading only slightly higher than when it first announced its Bitcoin pivot. The question on everyone's mind is, what does this mean for the future of the Bitcoin treasury trade? Will we see more consolidation in the space, and how will this impact the value of these companies' stocks? We'll be keeping a close eye on this story and exploring its implications in more depth as it unfolds. For now, it's clear that the landscape of the Bitcoin treasury trade is shifting. As the market continues to evolve, it's essential for investors to stay informed and adapt their strategies accordingly. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're halfway through our program, and we're diving into the world of finance and markets. Today, we're taking a closer look at the latest developments in the agricultural sector, as well as the overall market trends. We've got a plethora of stories to share with you, from corn and soybean exports to wheat prices and stock futures. Let's start with the agriculture sector, where export demand for U.S. corn has been robust, with weekly sales reaching 1.232 million metric tons. This is likely to provide a floor for futures prices, especially if trade talks between the U.S. and China continue to progress. Meanwhile, soybean meal futures have been struggling, with December contracts down 4.6 seconds. The soy complex bulls need to see an improvement in meal prices to make any significant headway. However, with the U.S. soybean harvest getting an early start, harvest pressure and commercial hedge selling may keep price rallies in check. Winter wheat market bulls also face challenges, with December soft red winter wheat futures falling 1 cent on the week. The technical bears appear to be in control, and the bulls will need some help from corn and soybean prices to get their market moving. Shifting gears to the broader market, stock futures are little changed after a 3-day win streak for the S&P 500. Investors are cautious about the risks associated with elevated market valuations, particularly when it comes to the AI trade. Questions remain about whether this trend can continue powering U.S. equities. As we navigate these complex markets, it's essential to stay informed and adapt to changing conditions. We'll continue to monitor these developments and provide you with timely insights to help you make informed decisions. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We've got a great closing segment for you today as we dive into the world of real estate and taxes. If you're considering downsizing your home for retirement, you'll want to stick around for this. Imagine selling your house and netting a whopping $640,000. Sounds like a dream come true, right? But as with anything in life, there are tax implications to consider. Our story today explores the ins and outs of capital gains tax and how it affects homeowners who are looking to downsize. According to the IRS, if you're married and filing jointly, You can exclude up to $500,000 in profits from the sale of your primary home from taxes. If you're single, that number is $250,000. But what happens when your gain exceeds those limits? That's where things can get a bit tricky. Let's break it down. If you're married and filing jointly, and your gain is $140,000 above the exclusion limit, you could owe around $21,000 in federal taxes, assuming a 15% capital gains tax rate. And if you're single, that number jumps to $58,500. Ouch! Now, there are ways to mitigate these taxes. You can accurately calculate your cost basis, including any eligible improvements made to the property. You can also offset investment gains with losses, a process known as tax loss harvesting. And in some cases, you might be able to use a like-kind exchange, also known as a 1031 exchange, to defer taxes until a later date. But here's the thing, these techniques come with their own set of rules and limitations. For example, special rules may apply if you inherited the home, and not all properties qualify for exclusion. You'll need to provide documentation to prove you lived in the property for at least 2 of the previous 5 years, and even then, there are residency period conditions to consider. So, what's the bottom line? If you're planning to downsize your home for retirement, it's essential to develop a strategy for managing capital gains taxes. Consider consulting a financial planner to get personalized advice tailored to your situation. And remember, tax laws are subject to change, so stay informed and adapt your plan accordingly. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, invest with caution.